Welcome back to Wealth Informed, the podcast that strips away the jargon and makes finance make sense.
and helps you figure out what to do with your salary before you accidentally spend it all on the weekend getaways.
Hi, I'm Philip, Phil for short.
And I'm Rajshekar or just Raj.
Between us, we have spent years in the finance and accounting trenches. We read the boring white papers so you don't have to. Our goal is to turn complex money concepts into easy, bite sized conversations that empower you.
Basically, Phil is a nerd, and I'm the guy asking the questions you're too afraid to ask.
Today, we are tackling the big one, risk. With respect to equity and debt, and how to figure out if you are a daredevil or a cautious turtle.
I prefer financially prudent turtle, thank you very much.
We'll see about that. Hey, listeners, got a question? Drop us a line at hello@wealthinformed.com. So let's get wealth informed.
We are learners and observers of finance just like you, but one step deeper so that you don't have to burn the midnight oil. Our content is designed to simplify financial concepts, not provide specific investment advice. Our goal is to help you grasp the fundamentals of investing so you can make confident financial decisions. And hey, we'll also explore a bit of the psychology behind investing because money isn't just about numbers, it's about mindset too. All right, disclaimer done. Let's dive in. Okay, Phil, I did some homework after our last episode. Did you know there are more than 2,500 mutual fund schemes in India?
Yep, it's a crowded marketplace.
It's a nightmare. How am I supposed to choose? It reminds me of opening Netflix on a Friday night. I spend 45 minutes just scrolling through titles, get overwhelmed, and end up watching The Office for the 10th time.
I feel that. But investing isn't exactly like picking a movie. You can't just turn it off if you get bored with it. It requires a bit more research.
But where do I even start? It feels like a Pandora's box. I saw terms like large cap, liquid fund, hybrid aggressive. It sounds like a foreign language.
It sounds complicated, but SEBI, the regulator, has actually organized them into categories to help us out. But ignore the 40 plus subcategories for a second. You only need to understand the three big buckets.
Okay, give me the buckets.
Okay, the first is equity, the fund that invests in stocks. Second is debt, that invests in bonds, which are typically loans. And the third is hybrid, which is a mix of the first two.
Okay, I hear these words all the time equity and debt. But what do they mean for me?
Let's break it down.
I know equity is a stock market, and honestly, it scares me. It feels like a giant casino where one day you're up, the next day the market crashes because someone tweeted something. It feels like pure luck.
I get why you feel that way. It is volatile, meaning the price jumps up and down, but it's not a casino. In a casino, the house always wins. In equity, if you pick good companies, you win. It is driven by business performance and not luck.
Prove it. How does it work?
All right, let's use an analogy here. Imagine our friend. Let's call her Priya. She's an incredible baker.
Oh, yeah, her chocolate truffle cake is to die for.
Exactly. So you tell Priya, you should sell these on Instagram. She listens, she starts a page, and boom, it's a hit. She's selling out every weekend.
Classic startup story.
Now she wants to expand. She needs a commercial kitchen, ovens, and professional staff. Let's say she needs 10 lakhs to make this happen. She puts in 6 lakhs of her own money, but she's short of 4 lakhs.
Okay,
She comes to us. She says, Phil, Raj, I really don't want to go to the bank and take a loan because the monthly EMIs will kill me if sales are slow. Instead, will you invest in my business?
so we give her the cash?
We give her 2 lakhs each. In exchange, she gives us a share of the ownership. Total capital is 10 lakhs. Your contribution is 2 lakhs. That means you own 20% of the company.
Okay, so I'm a partial owner now.
Correct. That is equity. You're a shareholder. If the business fails and the ovens explode, you lose your money. But if the business makes a profit of 1 lakh at the end of the year, what happens?
Since I own 20%, I assume I get 20% of the profit, so 20,000.
Exactly. And Priya becomes the biggest bakery chain in India over the next 10 years. That 2 lakh investment could be worth 1 crore.
Ah, I see now. So I'm taking the risk that she might fail in exchange for the chance that she might become huge.
Precisely. That is capital appreciation. The value of your share grows as the business grows. Now, let's flip the script. Let's talk about debt.
That usually stresses me out. Home loans, car loans, credit cards.
True, that's the debt you owe. But in investing, debt funds are about owning the debt that others owe you.
Wait, so I get to be the bank?
Exactly. Let's go back to Priya. Imagine she didn't want to give us ownership. She says, guys, I don't want to share my profits. Just lend me 4 lakhs and I will pay you 8% interest every year.
Okay.
In this scenario, you don't care if she becomes the next Starbucks or if she just stays a small kitchen. If she doesn't go bankrupt, she pays you your interest and returns your money after a few years. In equity, you are an owner, high risk, unlimited potential. Debt, you're a lender, lower risk, fixed return.
So when I put my money in a fixed deposit or FD or a debt mutual fund, I'm basically lending money?
Yes, when you put money in an FD, you are lending to the bank. When you buy a debt mutual fund, that fund is lending to the government or big companies like Reliance or Tata.
Why do some pay more interest than others?
It's basically risk. If you lend to the government of India, the chances of them defaulting is basically zero. So they pay lower interest, say 7%. If you lend to a new risky company, they might have to pay you 10% or 12 to convince you to take the risk. The thumb rule is higher the promised return in debt, the higher the risk that you might not get back your money.
Okay, I get the difference now. Equity equals ownership, high drama, high reward. Debt equals lending, boring, steady reward. But how do I decide what mix I need?
This is where we do risk profiling. It's like a financial personality test.
Oh boy, go on, analyze me.
We look at three things. The first is your ability to take risk. How much money do you have? If you lose it, will you starve? The second is your willingness to take risk. Do you panic when the market drops by 5%? And the third is your goal. When do you need this money?
Well, I'm in my 30s. I have a job, but I still hate seeing red in my portfolio. It ruins my sleep.
Based on that, you sound like a conservative investor.
Sounds about right. Safety first.
But here's the trap, Raj. If you're too conservative, you might lose money safely.
What? How can I lose money safely?
Inflation, the silent killer. If your safe investment earns 6%, but inflation, the cost of living, grows at 7%, you're effectively becoming poorer each year. Even a conservative investor needs some equity to beat inflation.
So, what's the right mix?
Generally, we see three profiles: the conservative, mostly debt, who owns 70 to 80% allocation for safety, and a little in equity, 20 to 30% for growth. The second is moderate, a balance, maybe 50-50 or 60-40 in equity and debt. And the third is aggressive, mostly in equity, allocates 80 to 90% into equity. These people don't mind market crashes because they're looking at 15 to 20 years of growth.
I think I'll start conservative to dip my toes in.
And that's fine. Your profiles change. When I started, I was terrified. I was a 100% fixed deposit person. Now I'm a moderate to aggressive investor.
What changed?
Time. I realized that over 5 or 10 years, the volatility smooths out and equity creates serious wealth. And that brings us to the secret sauce. The one thing that makes regular people rich: compounding.
Ah, yes. Einstein called it the eighth wonder of the world, right? He who understands it earns it. He who doesn't pays it.
You know your codes. Fun fact: Einstein was an investor. He put his Nobel Prize money into the stock market.
Did he really? Was he a genius at it as well?
He lost a huge chunk of it during the Great Depression crash of 1929.
Great. If Einstein couldn't beat the market, what chance do I have?
The lesson here isn't that you need to be a genius. The lesson is you need patience. Einstein lost money because the market crashed, but people who stayed invested for decades eventually made fortunes.
Explain compounding to me simply. No need for complex formulas.
Imagine a snowball rolling down a hill. At the top, it's the size of a tennis ball. That's your initial investment, say 1 lakh. After 1 year, at 10% return, it grows to 1.1 lakh. In the second year, you don't just earn interest on your original 1 lakh. You earn interest on the interest too.
It earns money on the new total, right?
Exactly. It starts slow, but let me give you a number that will blow your mind. If you invest 1 lakh once at a 12% return, which is a decent equity expectation, after 10 years, it becomes roughly 3 lakhs. Not bad. After 20 years, it nearly 10 lakhs. But after 40 years, can you guess?
I don't know. 30 lakhs?
93 lakhs.
Wow. It jumped from 10 to 93 in the same interval?
That is the magic of the later years. The money works harder than you do. But you only get that result if you stay in the market.
Okay, my brain is too full. So, to recap, equity is ownership, riskier but builds wealth. Debt is lending, safer but slower. Risk profiling is figuring out my sleep comfort level. And compounding is a snowball effect, but I need to be patient.
You nailed it. And remember, you don't need to be Einstein. You just need discipline.
I feel much better about diving into that Netflix menu of funds now.
That's what we like to hear. In our next episode, we are going to open the hood on equity mutual funds. We'll talk about large cap, mid cap, small cap, and which one will fit you right.
If you enjoyed this, please subscribe and share this episode with that one friend who keeps asking you which stock to buy. Until next time,
Keep questioning, keep learning.
and stay wealth informed.